things, or for example, properties that they're just looking to get appreciation in and there's actually no cash flow there. So in real estate specifically, what do you look for when you say this is a property I would invest in compared to this is a property I would not touch?
Yeah. I mean, in real estate, one of the biggest factors for me is really the area. If you wouldn't live in the area that you're buying in, I wouldn't buy that deal just because the tenants that are going to come with that property, they're not going to be like you at all. I mean, it's going to be a bad area. There's probably going to be crime and all kinds of things. So definitely I would buy in a good area. I would buy on the lower end of whatever market you're looking to buy in. I'd buy on the lower end. I wouldn't buy like these very sexy properties that you could possibly make a bunch of money on doing Airbnb rentals or something. I'd just buy something clean on the lower end of properties, 200,000 more or less, 300,000, something under that price range. That way, if there is some kind of a shift in the market, you'll still already be on the lower end of properties.
Okay. And when you look for properties, do you just say, I'm going to buy a property because of the cash flow that it's giving me in the specification that you just said, like this certain area that I would live in, lower end, but I'm looking at the cash flows? Or would you say, I'm getting into the best area to see if I can get the most appreciation possible? What is it you look for?
Yeah, there are some investors that are appreciation buyers. I'm not one of them.
Yeah.
I'm trying to build cash flow.
Yeah.
So
Yeah.
I need it to cash flow at least $500-600 a month. I know there's more percentages that go into it, but I like at least $500-600 because every property, even if you go on the lower price range, where if you cash flow a good amount based on the price, like you could have a crazy high return, 40%, but your cash flow is only $200 or something.
Yeah.
Then if something breaks, you lost all your money.
Yeah.
Like the returns look great on paper, but each property, no matter what their cost, like a refrigerator costs the same in a $100,000 property than in a $50,000 property.
So to getting to that point, that's something that I want our viewers to understand as well. And it's, when you're just looking for appreciation, that's the wrong way to look into investing, especially in my opinion, and I believe Julian's opinion too. So for example, if you're looking at a business, just to get away from like real estate, so just put a different comparison, just because it's a great business does not mean that it's a great investment. So it could be an amazing business. Like I'll give you an example, like Tesla when it was at its highs. It's still an amazing business, but that does not mean that it's an undervalued business and a great investment at that price. So that's why when you're looking at real estate or stocks or businesses or any type of investment, you have to understand the discrepancy between the value and the price. And you have to try to get into things that are undervalued. That's why Julian said, for example, the lower priced ends of the properties, that in that good area that you're looking for, because those are the ones that are the most undervalued properties that most likely will appreciate, but that's not the determinant factor for getting into that investment.
Yeah, and I think appreciation buyers are really they're speculators.
Yeah,
like
exactly.
you're buying an asset and you're praying to God every day that it's going to go up in value.
Yeah, and that's the only way you'll make money out of it, because those appreciation buyers are most likely not getting cash flows.
Yeah,
or they might be breaking even, maybe even less, losing a little bit of money a month, and
just hoping that it's going to appreciate. And honestly, anyone that's bought a property in the last 5 years, they've done very well being appreciation buyers.
Yeah.
But who knows that trend is going to continue forever.
Exactly.
I mean, and going back to like undervalued properties, comparing them to undervalued businesses, that's a good comparison on your end. But like for a property, for example, let's say it's a property with 1,200 square feet and it's only a 2.2 right now. Maybe you're able to squeeze in a 3.2 in there, and you just bought a property at 2.2 price, and you're able to convert it to a 3.2 with only putting a wall of drywall up, which costs under $1,000.
Yeah.